Good evening. Tonight we are tracking a significant and closely watched development in global precious metals markets. Silver prices experienced a sharp single-session decline today, falling from a high of $87.45 per ounce down to $83.74, a drop of $3.71, representing a loss of approximately 4.24% within a single trading day. For context, this move occurred against a backdrop of what analysts describe as strengthening underlying demand for physical silver, making the scale and speed of today's decline a subject of serious scrutiny among market observers. At the center of this story is a fundamental tension between two very different silver markets: the paper futures market based in the United States and the physical delivery market operating out of Shanghai. Understanding that distinction is essential to understanding everything that unfolded today and everything that is now unfolding overnight as Asian markets open for business. To properly explain today's price action, we must look back not just to this morning's open, but to conditions that were quietly building in the financial system over the preceding 72 hours. Specifically, elevated stress in the overnight repurchase agreement market, commonly known as the repo market, appears to have played a direct and measurable role in today's silver price movement. The repo market serves as the short-term cash lending infrastructure of the global financial system. Banks and financial institutions use it to borrow overnight funds by posting collateral, including treasury bonds and precious metals derivatives. The interest rate on these loans, the repo rate, is a closely watched indicator of system-wide liquidity. When that rate spikes, it signals that institutions are scrambling for short-term cash. On Tuesday of this week, the overnight repo rate climbed to 4.87%, a reading that market observers characterize as a notable stress signal within the current Federal Reserve-managed environment. When that kind of institutional cash pressure builds, history shows a very specific and well-documented response tends to follow in commodity markets. And today, that response arrived in silver with considerable force. To understand what happened in silver markets today, it is necessary to understand the distinction between paper silver and physical silver, because that distinction is not a technicality. It is the foundation upon which today's entire price move was built. Paper silver refers to futures contracts traded on the COMEX exchange. These contracts are not silver. They are derivative agreements, numbers recorded on servers, that under standard market conditions do not result in the delivery of any physical metal whatsoever. The ratio of outstanding paper-silver contracts to the amount of registered physical silver actually available for delivery at the COMEX currently sits at approximately 378 to 1. That means for every single ounce of registered physical silver available for delivery, there are 378 ounces worth of paper contracts outstanding against it. According to publicly available CME data, registered COMEX physical silver inventory has remained below 120 million ounces for most of the current year. With that structural reality established, here is the sequence of events that drove today's decline. It begins with the accumulation of a large short position in paper silver futures on the COMEX. Entities holding these short positions profit when the price of silver falls. The timing of when those short positions are activated is not random. It follows a recognizable and documented pattern. Traders wait for a period of retail market enthusiasm, a stretch of days in which silver has been climbing, sentiment is bullish, momentum following funds are adding to long positions, and retail investors are actively engaged. Silver had been on exactly such a run heading into today's session, reaching $87.45 in early trading. That is the moment the selling began. High-frequency trading systems, capable of executing thousands of orders per second, deployed large volumes of paper sell orders into the market within a window measured in milliseconds. The institutions operating these systems include entities that have previously settled with the Commodity Futures Trading Commission and the Department of Justice over silver market manipulation, paying financial penalties on multiple occasions over the past 15 years. The initial wave of algorithmic selling pushed the price downward. That downward movement then triggered a secondary and self-reinforcing effect. Retail traders who had placed stop-loss orders beneath the market, a standard risk management tool, found those orders automatically activated. Each triggered stop-loss became a market sell order. Each market sell order pushed the price lower. Each incremental price decline triggered additional stop-loss orders, producing additional sell orders, driving the price further down still. This mechanism is known as a liquidity cascade. It is a self-reinforcing sequence in which each forced liquidation triggers the next. Critically, once the initial algorithmic sell pressure primes the cascade, the originating entity can step back and allow the chain reaction of retail stop-loss liquidations to continue the downward move. The result? Silver declined from $87.45 to $83.74 within a single session, a drop of 4.24%. The institutions holding short paper positions raised cash to address their repo-related liquidity needs. Retail investors holding long positions were liquidated, and the paper short positions generated profit. What makes this sequence particularly significant is the context in which it occurred. Fundamental demand for physical silver has not weakened. Mine supply has been chronically underinvested. Industrial consumption, driven by solar energy, electric vehicles, and high-frequency electronics, continues to expand. The price decline was not a reflection of deteriorating silver fundamentals. It was the result of paper contract mechanics operating on a leveraged system with a 378-to-1 ratio between promises and physical metal. The distance between what the COMEX paper price says silver is worth and what buyers are actually paying for physical metal at dealers and coin shops, a figure known as the premium over spot, is a more direct measure of real-world supply and demand conditions. That premium has not been narrowing as nominal silver prices have risen from $25 to $50 to the current range near $83. It has held steady or expanded, a persistent signal from the physical market that available supply is tighter than the paper price alone would suggest. That gap between paper price and physical reality brings us to the second major dimension of tonight's story, one unfolding not in New York, but on the other side of the planet, where the business day is already underway and where today's price decline is being read in an entirely different context. As American markets closed today and retail investors absorbed a 4.24% decline in silver prices, a parallel and structurally significant development was already underway on the other side of the world. The Shanghai Gold Exchange, the world's largest physical precious metals exchange, opened for business with silver priced at $83.74 per ounce. And the response from buyers operating within that market was notably different from the reaction seen in Western retail circles. The Shanghai Gold Exchange operates on a fundamentally different structural basis than the COMEX. Where the COMEX functions primarily as a paper derivatives market with a 378-to-1 ratio of paper contracts to registered physical metal, the SGE operates predominantly as a physical delivery market. When a contract is purchased on the SGE, physical metal is in most cases actually delivered to the buyer. The ratio of paper to physical on the SGE is effectively 1-to-1. This structural difference means that when COMEX algorithmic selling pushes the paper price of silver downward, Eastern physical market participants do not experience that move as a signal to sell. They experience it as a reduction in the price of real metal, a buying opportunity. China's capacity to act on that opportunity is measurable and publicly documented. The country has accumulated a trade surplus of $214 billion over a recent reporting period. To illustrate the scale of that buying power in concrete terms, if just 1% of that surplus, $2.14 billion, were deployed into physical silver purchases at $83.74 per ounce, it would represent the purchase of approximately 25.5 million ounces of physical silver. That single figure represents more than 20% of the entire registered COMEX deliverable inventory, which has been running below 120 million ounces for most of the current year. That calculation is drawn entirely from publicly available trade data and publicly available COMEX inventory reports. Chinese sovereign and institutional buying into COMEX price declines is not a new phenomenon. It is a documented and consistent pattern in the physical precious metals market. The SGE has maintained a persistent premium to London benchmark prices, meaning Chinese buyers have been willing to pay more for physical metal than the Western paper price indicates, a pricing behavior that is only economically rational when buyers are purchasing for strategic, long-term fundamental reasons rather than short-term speculative trading. India represents a second and structurally distinct dimension of Eastern physical demand. Indian silver imports have been running at record levels, according to publicly available data from India's Commerce Ministry. The drivers of that demand extend beyond institutional or sovereign strategy. India has a deeply rooted, generationally transmitted cultural tradition of physical silver ownership that has no direct Western equivalent. In the current macroeconomic environment, characterized by a weakening rupee and broad global inflationary pressure, that tradition is being reinforced by straightforward economic logic. Converting currency holdings into physical metal is a rational response to documented purchasing power erosion, and it is a response that hundreds of millions of Indian households are making simultaneously. Beyond China and India, the broader geopolitical and monetary context of 2026 adds further structural weight to physical precious metals demand. The BRICS economic bloc, which now includes Russia, China, India, Brazil, South Africa, Saudi Arabia, Iran, the United Arab Emirates, and additional members following the expansion that formalized in late 2024, has been methodically constructing the infrastructure for a trade settlement system that operates independently of the SWIFT financial messaging network and the US dollar. Bilateral currency swap agreements covering a significant and growing fraction of global trade are operational realities in the current year. Discussions around commodity-backed trade settlement, including gold and silver, have progressed beyond theoretical frameworks. When trade is settled in a currency explicitly or implicitly backed by a physical commodity basket, the demand for that physical commodity shifts in character. It is no longer purely investment demand, jewelry demand, or industrial demand. It becomes monetary demand, the kind of demand that does not respond to algorithmic price signals, does not carry stop-loss orders, and does not get shaken out by a single-session 4% decline. It accumulates systematically at every available price level because the end use of the metal is monetary system architecture, not short-term price speculation. The United States fiscal position provides additional context for understanding why sovereign and institutional entities managing capital on multi-year and multi-decade horizons are increasing allocations to physical hard assets. The national debt currently exceeds $36 trillion. Annual interest payments on that debt at current rates exceed $1 trillion, a figure that surpasses the entire annual United States defense budget of approximately $900 billion. The debt-to-gross domestic product ratio is in territory that has historically preceded significant monetary stress events in other sovereign contexts. Silver's position within this environment carries a specific characteristic that distinguishes it from gold. Silver is simultaneously a monetary metal and an industrial metal, with an expanding demand profile tied to technologies with substantial long-term growth trajectories. The photovoltaic solar industry, electric vehicles, high-frequency electronics, medical devices, and water purification systems all consume silver in applications where a significant fraction of the metal used is not recovered or recycled. It is consumed permanently. Mine supply, chronically underinvested during a period of suppressed paper prices over the preceding decade, has not kept pace with the growth in that industrial demand. The supply and demand equation for silver, evaluated independently of COMEX paper leverage, presents a fundamentally different picture than the $83 paper price implies. Two additional structural mechanisms deserve attention before we close. The first is rehypothecation, the practice of using the same physical collateral to simultaneously back multiple financial obligations. Under this practice, a single physical ounce of silver can appear on multiple institutional balance sheets at the same time. In normal liquid market conditions, this creates no immediate problem. In a market stress event, when multiple institutions simultaneously require physical delivery of their collateral, rehypothecation produces a severe shortfall between the metal that has been promised and the metal that actually exists. The Basel IV International Banking Regulatory Framework has been working to address precious metals rehypothecation, and the implementation of those requirements has contributed to the physical supply tightness visible in the market in the current year. The second mechanism is what market observers describe as a potential gamma flip, the point at which the structural forces that have historically dampened upward silver price volatility reverse direction and begin amplifying it instead. The combination of a large COMEX short position, declining registered physical inventory, sustained Eastern physical buying, and expanding industrial demand creates a mathematical environment in which the paper market's capacity to contain price discovery through leverage becomes increasingly strained. Force majeure, the formal declaration by an exchange that it cannot fulfill settlement obligations, has moved from a theoretical discussion into the active risk management frameworks of major financial institutions. These are the structural forces in motion tonight as Asia absorbs physical silver at $83.74 per ounce. As we bring tonight's coverage to a close, it is worth stepping back from the individual mechanics of today's session and placing everything we have examined into a single coherent picture. What happened in silver markets today was not an isolated event. It was one visible expression of a much larger and much longer structural story, one that connects overnight repo market stress in the American banking system to algorithmic futures trading on the COMEX, to physical delivery markets in Shanghai, to sovereign wealth accumulation strategies across the Eastern Hemisphere, and ultimately, to the broadest questions about the global monetary architecture of 2026. Here is the sequence in its simplest form. Elevated repo market stress, reflected in an overnight repo rate spike to 4.87% on Tuesday, created institutional demand for short-term cash. That demand was addressed in part through the deployment of high-frequency algorithmic selling in paper silver futures on the COMEX. The resulting liquidity cascade, driven by the triggering of retail stop-loss orders in a self-reinforcing chain, pushed silver from $87.45 to $83.74 within a single session, a decline of 4.24%. Paper short positions profited, retail long positions were liquidated, and the evening financial press characterized the move as routine market volatility. Simultaneously, and largely absent from mainstream financial coverage, the Shanghai Gold Exchange opened to Eastern buyers who received that same $83.74 price not as a distress signal, but as a discount on physical metal. China, operating with a documented trade surplus of $214 billion, possesses the capacity to deploy 1% of that surplus and purchase more than 20% of the entire registered COMEX deliverable silver inventory at the current price. India, running silver imports at historically elevated levels according to publicly available Commerce Ministry data, is adding to global physical demand from a cultural and macroeconomic foundation that is broad, distributed, and durable. Additional sovereign and institutional buyers across the Middle East and Southeast Asia are making parallel allocation decisions driven by the same fundamental calculus: the conversion of fiat currency surpluses into finite physical assets in an environment of documented monetary expansion and declining dollar purchasing power. The structural imbalances underlying all of this are measurable and public. The COMEX paper-to-physical ratio of 378:1 is drawn from CME data. The registered COMEX silver inventory figure of below 120 million ounces is a matter of public record. The SGE premium to London benchmark prices is documented. Indian import volumes are reported by government trade authorities. The United States national debt exceeding $36 trillion and annual debt service costs surpassing $1 trillion are figures available from official government sources. The Federal Reserve's M2 money supply expansion of 27% in the single year of 2020 is a matter of historical record. None of these data points require inference or assumption. They are the factual landscape within which today's silver price movement occurred. The near-term market structure presents a specific dynamic worth monitoring. The entities that executed today's algorithmic short selling now hold open paper short positions in a market where physical supply is being actively absorbed by Eastern buyers overnight. As physical metal moves from Western vaults into Eastern delivery infrastructure through the SGE, the available float that underpins the Western paper pricing system contracts. The cost and difficulty of maintaining large short positions in a physically tightening market increases. If overnight SGE physical premium data and Shanghai delivery volume figures show aggressive accumulation at current price levels, the Friday morning session opens with a short position that faces the prospect of either holding through a closed weekend market or initiating short covering, buying back paper contracts, which in turn exerts upward pressure on price. This Friday short covering dynamic is a pattern with documented historical precedent in silver bull market conditions. Longer term, the Basel IV regulatory framework's ongoing impact on precious metals rehypothecation continues to expose the gap between the physical metal that Western financial institutions have formally committed to and the physical metal that actually exists in unencumbered form within the system. That discovery process, as institutions are required to demonstrate genuine physical possession of collateral rather than chains of paper claims, has contributed to the inventory tightness already visible in COMEX registered stock levels and is not yet complete. Its resolution carries significant implications for the relationship between paper silver prices and physical silver prices going forward. Silver's dual identity as both a monetary metal and an irreplaceable industrial input, consumed permanently in solar panels, electric vehicles, medical devices, and high-frequency electronics at rates that existing mine supply pipelines are struggling to match, means the demand pressures bearing on the physical market are not dependent on any single driver. Monetary demand, industrial demand, and sovereign accumulation demand are operating simultaneously and independently, each reinforcing the others. The dealer premium over spot price, what buyers are actually paying for a physical ounce of silver at retail level, remains the most direct available measure of the gap between the COMEX paper price and the physical market reality. That premium has not compressed as nominal silver prices have risen through the $25, $50, and current $83 ranges. It has held or expanded. The physical market is sending a consistent and unambiguous signal that available supply is tighter than the paper price alone reflects. Tonight, as Asian markets conduct their business and physical silver changes hands at prices set in part by algorithmic activity in New Jersey futures markets, the data tells a story that the headline price number alone does not capture. A paper price of $83.74 exists within a system where 378 paper ounces are outstanding for every registered physical ounce, where Eastern sovereign entities with $100 billion surpluses are systematic buyers at every available price level, where industrial consumption is permanently removing metal from the market at expanding rates, and where the regulatory and structural pressures on the Western paper pricing mechanism are, by all measurable indicators, intensifying rather than easing. That is the full picture of what happened in silver markets today, what is happening tonight, and the structural context within which both must be understood. We will continue to monitor overnight SGE premium data, Shanghai physical delivery volumes, and COMEX inventory figures as they develop, and we will bring you that data as it becomes available. For now, that is tonight's coverage. Thank you for watching.